recently I was in Denver, Colorado giving a speech, and I was commenting on something that got a lot of excitement in the crowd. And so a number of people have asked me to, would I mind recording it? And this is what I'm doing to kind of share it with all of you. And it's a story, true life story that actually happened with a client I had about 20 years ago. And essentially here's what happened. I was trying to work with this individual to explain to him how to create better motivation for his employees through a better way of doing employee incentives and profit sharing and bonuses. And essentially what I was taking it into was you couldn't just award bonuses based on revenue, and you shouldn't award bonuses based on what you think you have available. Instead, you needed to understand what your true break-even was of the company, or your client's companies in this case. And the true break-even is not just when revenue and expenses and taxes equal the revenue, but it's when revenue is equal to fixed expenses plus variable expenses plus depreciation plus tax plus cash reserves, because almost nobody positively cash flows every month, plus money to reinvest for growth, plus money for opportunity. You know, the world changes all the time. Sometimes there's an opportunity, maybe a competitor goes out of business, or there's some risk available to you if you want to expand into a new area. And you have to calculate how much you want to set aside for all of that money. But once you know what your true break-even is, then the thing that's really elegant about it is, unless you hit an issue of capacity with human resources, in other words, you might need more people to continue to grow, you never have to spend your depreciation or your fixed twice in 1 month. And so there's this magic formula that comes in where the percentage of fixed expenses and depreciation against revenue is actually the percentage of net pre-tax profitability that the business makes on every dollar or pound or euro above break-even, above true break-even. So the reason this becomes really interesting is, for most businesses, this fixed percentage tends to be between 50 and 70%. In service businesses, it can even be higher. Now, unless you are in a manufacturing environment, extremely high volume, low margin, where it might be, the fixed might be as low as 35%, they tend to be pretty frequently pretty healthy percentages. So my recommendation to my client was that he offered employee bonuses quarterly based on a percentage of profits above true break-even. And he just didn't get it. How much should I offer? I said, well, with the number of employees you have, which he had 14 or 15 at the time, I said, I think it should be 25 to 30% of your net pre-tax profit quarterly against true break-even. That's too much money. That's coming out of my wallet. And I said, no, 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 you don't understand. There's only 3 ways for a business to increase its profitability. It can increase revenue at a faster rate than it increases expenses. I mean, we don't want to go, yeah, I'm losing a penny on every sale, but don't worry, I'll make it up on volume. So it has to increase revenue faster than expenses, or you can decrease costs and expenses, or you can do the best thing, which is improve efficiency. Because then as the efficiency improves, you're getting more work done on the same cost, and the profitability goes up. There's only 3 ways of doing it. That's still too much money to give to them. And I said, well, you know, the only common denominator in all those 3 profits are the employees. They're the ones that cause it to happen. Yeah, but it's too much money. In frustration, I threw up my hands and I say, do you have a quarter? He said, what? I said, do you have a quarter? Yeah, I've got a quarter. I said, give it to me. What? I said, give it to me. He says, am I going to get it back? I said, you're taking me out to lunch and you're worrying about spotting me a quarter? Give me a quarter. So he hands over a quarter, and I pull out my wallet and I hand him $1 back. He said, is that mine to keep? I said, yeah. You're sure? I said, yeah. Then I said, do you have a quarter? You want another quarter? I said, yeah. Give me another quarter. So he opens up his, takes his hand out of his pocket, he hands me another quarter. I give him another $1 back. And I looked at him and said, how long are you willing to do this? And it dawned on him. By giving the quarter to his employees, he actually was increasing his profitability because the employees were motivated to increase profitability through increasing revenue faster than expenses, decreasing costs, and improving efficiency. To prove how true this had been, his receptionist, a very sweet lady, had never worked for more than minimum wage, which back 20 years ago was not a whole lot of money, single mom, 2 teenage daughters, basically living in a trailer home. And they had hired her, very sweet lady. I'm going to call her Crystal. And Crystal was the sweetest lady, the sweetest receptionist. And Steve comes into the office one morning, and he goes into his office, and the air conditioning's turned off, the lights are off. So he thinks, oh, okay, so he goes into the office, turns on the air conditioning, turns on the lights, goes through his mail, checks his email, gets up, and starts to do his walkabout, because he managed by walkabout. Well, when he comes back, the door to his office is closed, the air conditioning is off, and the lights are off. And he thinks, this is strange. So he goes in and he works for a little bit, and then he goes out to lunch, and when he comes back, the door is closed, the lights are off, and the air conditioning's turned off. And they were in actually in southern Ohio. I know it was hot, really. It was summertime in southern Ohio. And so he turns on the air conditioning, and he comes out, and he says, Crystal, what's going on? Every time I leave the office, the lights are off, and the air conditioning's turned off, and the door's closed. She says, oh, I'm doing that. He says, why? Well, that stuff costs money. It eats into our profit sharing. And I was there when her first bonus came in at the end of the quarter. And he handed her, a check in a sealed envelope, and she takes it and looks at it, and she gets really frightened, and she hands the check back, and she gave me the wrong check. And Steve goes, oh, what? Oh my God, no, no, no. And he looks at it and says, no, that's your name on the check. And he hands it back to her, and she started to cry. The check after tax was for $2,300 and some dollars. It was more money than she'd ever seen in one place. Now tell me, would you like to have employees that do that? Now, obviously, the reason I'm talking to you about this is not just to teach you better tactics for creating efficiency and cost savings among employees and giving them a motivation through your profit sharing structures, but it's to tell a different story. Some of us were around when there were no spreadsheets, and we used to do bookkeeping and accounting with pencil and paper and ledgers. And then, of course, spreadsheets came on the scene, and then accounting software came on the scene, and QuickBooks became popular, and Sage became popular, and all of a sudden businesses were using automated ways of doing accounting, which is wonderful. But the latest generation of what's gone on in the accountancy world is cloud-based technology. So, for example, the fastest growing cloud technology in the world right now is a company out of New Zealand called Xero, X-E-R-O. Pretty amazing. Prophecy is a strategic partner with them. Intuit, so concerned about this, has done two things. They're not only strengthening their QuickBooks Online, which is their cloud-based QuickBooks product, but they're actually taking all their desktop things and they're having them to be able to link synchronously through the cloud without having to use a remote server, which is incredible. So everyone is moving this direction. Sage, for example, which acquired MAS and Peachtree in the United States, and they have a huge performance in the United Kingdom and in the EEC, they also are migrating their things to cloud-based interfaces. Well, why is this important? It's important because companies like mine, like Prophecy, are able to create incredibly powerful analytic tools that allow you to do things that only CFOs and analysts and multinationals do, and for a pittance compared to the fees that you can charge to provide CFO level services to your clients. Now, there are a lot of different types of providers. We happen to do financial analytics. There's people that actually do management of rentals and leases of apartments. There are products that do efficiency in shipping. There are products for micro businesses that actually scan expenses and load them into the accounting software. There's all kinds of incredible value-added products. But the thing I want you to understand is that the cost of a licensed product, like the Profit Seat products, is that 25% that's going to pay you back the 75%. It's the quarter that's going to pay you back the dollar. And frankly, many of the products, ours included, it's not 25%. It's like 5% and a 20-to-1 return on what you can provide to your clients as a service and as a fee. And the thing that's nice is the client is receiving services that they would have to pay a fortune for with employment. But you're able to provide it in a very efficient, very effective way because of what technology is doing. So just remember, if I ask you to give me a quarter, will you do it?